Hey there, welcome to Financial Wellness University, where we learn the 7 phases of financial wellness to bring us from financial distress to financial wellness. Now, today we're going to look at something that very important. We're going to look at investing. Stay tuned. Okay, so we're looking today at the importance and just the basics of investing. Now, for those of you who are not subscribed, please do so that you will be a part of this financial revolution of impacting your life for generations by learning some of the basics that we should have learned as children, but we didn't. And even as adults, many of us have never learned some of the things that they keep the wealthy wealthy and the rich rich. So let's learn some of those. And one of the main ways that happens is through investing. Now, before we get more into it, can you put a like down low so that this video can be seen by more people? Now, also when you subscribe, there's a little bell. Hit that little bell at the top of the screen, and that way you'll be notified when videos become available. Again, my name is Joe Brown, and this is Financial Wellness University. Now, the formal or the investing market that we're familiar with started around 1790, actually in Philadelphia. And then a few years later, the New York Stock Exchange was formulated, and it became and still is the largest stock market or stock exchange in the world. Now, what does that mean, stock exchange? In basic terms, because that's what I want to help you understand stuff in basic. You don't have to be a stockbroker or a financial planner in order to start investing. You just need to understand some basic things. And stock exchange. Well, what is stock? Stock is an ownership interest in a company. That's how, when they say a company goes public, that means they are selling a portion of their company through a stock, a financial instrument, and you own a portion of that company. So they'll sell a share at a certain price, say $100 a share. So if you're willing to spend $1,000, you'll get 10 shares. Now, of course, that price fluctuates, goes up, goes down. Our goal is to buy it low and eventually sell it high. So say that $100 you buy goes to $500 a share. Now that's the time to sell. Now, traditionally, people like Warren Buffett say buy and hold for the long term. You know, don't get into this day trading where you're buying and selling the same day. And some people can be good at that, but this is a teaching for the vast majority of people. The vast majority of people are not going to do individual stocks and buying and selling on a daily basis. There's people who spend their whole life and still can't beat some of the average in the market. So, we want you to get into the stock market because traditionally it has gone up. It has always been in an upward trend. Even though there's some dips, we had the Great Depression in 1932. We had the Great Recession, 2006, 2008. That period around there, we had another dip in the 80s. But every time there's a dip, that's a time to actually buy even more because prices are even lower. And if you buy in a dip, now when it rises, you get even more profit, even more interest on top of what you own. Now, rather than buying an individual stock, you can buy what's called a mutual fund. A mutual fund is basically a bunch of different stocks of different companies all bundled together in one product. So when you buy a share of that mutual fund, that one share is basically paying for a whole list of companies. It could be 100 companies, it could be 500 companies, depending on what you invest in. There are things what's called the index funds, which aren't actively managed. It just put the money in and let the market do what the market does. And it traditionally is around what, 9% or something in that range. Now, if you have a fund manager who can beat that, then go for that. But why pay somebody to do what to get results that the average is getting without all the funds? So that's why index funds have become that's created by Mr. Vogel there at Vanguard. He did something very revolutionary in the industry where instead of having a team of people that buy and sell on a regular basis and try to beat the market, he just took a bunch of companies and said, whatever they do, that's what they do, and the average is still pretty good. So that's one way of getting in the stock market. Go to an index fund. But talk to your investment professional. And in terms of an investment professional, I recommend what's called a fiduciary. A fiduciary is a person who's supposed to work on your interests and only gets paid from you. That's one of the key elements of the better fiduciaries. They only get paid from what they charge you. Generally, it's a percentage of your net worth. Say if you have $1 million invested, well, they get 1% of $1 million. Now, depending on if you're just starting, they might have a flat rate to get started and then go to a percentage at a certain time. But the ideal is that they are not swayed by certain stocks that get higher commissions because they're not going to get paid from those particular commissions. They're going to get paid from you as the investor. So, and depending on what you're doing, you want to at least start with a fiduciary until you learn more about the investment market. Now I say start with a fiduciary. If you're not investing at all, start with a fiduciary. But what I really, the number one best investment for a beginner is if you are with a company that does matching. If they match your investment, then go for that. I mean, if it's a quality company and they've been around for a while, go with a company that's matching your investment. What I mean by matching, what that means, if I invest $5,000, they're going to invest $5,000, and it's usually up to a certain percentage of your income. So if you make $100,000 and they're matching up to 5%. You can pay 5% or $5,000, and then they'll match it and give you another 5. So it's almost like doubling your money right from the start. So that, you know, it's already beating the market, because that's 100% growth right away. Okay, so that's number one. Then there's the Roth IRA, which now let me go back. The stock matching is pre-tax, which means you don't have to pay taxes on that money, and it lowers your taxable income. So you put $5,000 away, it lowered your $100,000 income to $95,000. So you only get taxed on $95,000 that year. Now, when you eventually take it out, you're going to be taxed on it. Now, the flip side is the Roth IRA. You put taxable money's already been taxed inside of that investment, but when you take it out, you don't owe any taxes because you already paid the taxes. So they put a limit on how much you can put in that, because everyone would put, you know, half their income in it. So it's a limit based on your income, and if you're over 50, you get to add a little bit more. It's around 7,000. I forget the exact number, but you'll know it when you time to invest, and that grows tax free. So that is one of the ways you can get into the investment game. Don't put this off. The sooner you start, the better. Now, one example, a classic example that's always talked about, is one guy starts at 20. He puts away, let's say, $500 a month, and he does that for 10 years. Another guy doesn't do any investment, but he starts at age 30, and he does that until he's 60. Now, the first guy did it for 10 years and stopped. The next guy did it for 30 years, but he started 10 years after the other guy. When you look at the two, the guy who started early, investing the same money, had more than the guy who invested for 3 times the amount of years. Why? Because compounding interest. That money grew. So the first guy had money here when he stopped. The second guy started down here, right? So they were growing, you know, at the same time. But the other guy, the second guy, started late. So his money had to accumulate to the point where even would match what the other guy had invested, the first guy. So the sooner you start, the better. So I give you three tips when it comes to investing. I'm not an investment professional. I don't get paid to sell products. I just get paid to educate. So if you want a full education, you can look at the link down below to videos that will give you a full education into finances through a platform called mastermind.com. Check the link below, and you'll get a full education on all the things that we teach in the 7 phases of financial wellness. But in terms of this video, 3 things that you should do in terms of investing. Pick a little amount that you're going to invest regularly every time you get paid. That's called dollar cost averaging. That means when the market is up, you're buying fewer stocks. When the market is down, you're buying more, but you're using the same amount every time. Start as soon as you can. Put a consistent amount every time you get paid, and leave it alone. And let it grow. And see your wealth grow. I hope this has been educational. Give me a thumbs up so that this video will be broadcast to more people. If you haven't subscribed, please subscribe and hit the bell so you'll be notified. Look at the links below so that you can get even more information about how to improve your finances. Thank you and God bless.